this is a unique impact investment. Has anybody heard the term impact investment? Has anybody heard that term? Shane has. Okay, so in the private equity world, this is a new cliche term that's out there where people with a whole lot of money, they don't want to just go invest in the ordinary everyday stuff. They want to invest in things that has an impact. They want to do something that's meaningful for the world, it's meaningful for our society, it does something good, it leaves a legacy. It's more than just an investment, it also feels really good. And so that's what we do. The wildlife industry is a great example of an impact investment where you have the opportunity to leave a legacy behind for your family while simultaneously making money in the process of it. So this is investing. It is a reliable investment, and there are a few reasons why. Tax incentives, tax-favored income, and significant land appreciation. So, and for what it's worth, there are printouts of this presentation. Katie will get you those printouts. Okay, there's printouts on the table, great. So you can, if you want to take notes, but if you have questions as we're going along, just raise your hand. But feel free to follow up with me on any of the things that are in this presentation as we're going along. So this is my favorite part. So I love tax strategy. I'm one of these idiots that reads the tax code. I spend a lot of time trying to understand what's going on with our politicians and the regulations that they're passing and how that affects my life and how it affects our industry and how it is that I can capitalize on it and take advantage of it. And so what I have learned since getting involved in this industry is that pretty much everybody that owns a ranch has a CPA. They might even have a CFO. They might even have a person that they really trust from a tax perspective. But as a general rule, there's a lot of things that your CPA is not telling you. And in fact, it's probably flying off the radar and you're not getting any benefit from it at all. And you absolutely have the ability to do so, not through a loophole, but through very basic tax strategy. So you can convert your ranch, which is a vacation home, into an economic enterprise. Does anybody in the room here have a vacation home somewhere? Nobody has a vacation home? I'm not buying that for a second. Okay, you cannot write that off, okay? It's a vacation home, right? You don't get to write it off. The IRS says, no, we're not gonna let you do that. Like, it's a vacation home, it's not an investment. You can play whatever little shell game you wanna play. This is not gonna give you a tax benefit. And they're very firm about that, okay? But your ranch has the ability to be an economic enterprise. And I always love the idea when you hear someone talking about, well, I own a construction company and we have white-tailed deer and I send old Billy Bob out there and Billy Bob shoots a white-tailed deer and my ranch then writes a check to my company for $5,000, yada, yada, yada. You probably all know the story. Well, that doesn't result in very much tax savings. It doesn't result in a very big benefit. It's really pretty much inconsequential in the big scheme of things. And CPAs hate it. They don't like it, and they don't like it because the IRS doesn't like it. They know what you're doing, and so that little trick, while it sounds great, and maybe it feels good from the perspective of you think you're getting a tax benefit, it's really inconsequential. It's not really doing a whole lot, and if you look at your quarterly tax bill, you can confirm that. You're probably paying a lot in quarterly tax, and so these little things that you're doing, they're not really working. They're not that effective. And so by converting your ranch into a vacation home, you then are able to utilize depreciation, which is section 179 in the tax code, and bonus depreciation as a financial tool. Exotic livestock breeding, it makes other costs that you are already incurring on your ranch tax deductible. You can make improvements to your real estate with money that is tax deductible. You are eligible for QBI, which is qualified business income, which we'll get into all of these as I walk through this. And your offspring, their tax favored income, capital gains versus ordinary income. And again, this is not a loophole. This is not some secret, it's not some, kind of gray area that we're living in within the law. It is very black and white, it is very easy to understand. And one of the things I greatly enjoy is when ranch owners call me and ask me to talk to their CPAs, and Shane back here is a good friend of mine. Shane had a situation where he wanted some help. We got on the phone and we were able to walk through these things, and I don't think there was any debate or argument about the facts that were presented related to the tax benefits. And so this is not a loophole, it's not a secret, and it's not a gray area. It's very black and white, and it's very easy to understand. So from a vacation home business enterprise, without an operating business, your ranch is just a vacation home and it does not qualify for any tax incentives whatsoever. And exotic breeding exotic wildlife, if it is structured and operated properly, you can in fact turn your ranch into a cash flow positive business, actually, if you want to work at that, but you certainly can create significant tax benefits as the result of doing those. These are some of the key steps, and some of you may or may not have already done this, but create an entity. So you do need an entity if you're going to take advantage of these benefits. While you might be able to do it personally and get some of them, it's much better to have an LLC or some other kind of an entity. You want to create a business plan. So I'm sure many of you in this room are self-employed, and I'm sure many of you in this room have created a business plan at some point in time. Is that accurate? Just a nod of the head. Anybody ever created a business plan? How many of you have followed them? None of you, most likely. They're very difficult to follow. Mr. New follows his business plan, he says. So he's pretty disciplined, I'm going to say. But most business plans, they change and they move and they alter, and they're not the same all the time. They don't work out exactly as you plan. But the fact that you have one says something to the IRS. This is a defense against what your CPA loves to tell you, which is that you have a hobby. This is a hobby that you're involved in. And so having a business plan is a legitimate defense against being classified as a hobby. So why not get one? Put it together. Like, if you can't do it, we have a company that does do that. We will actually create a full-blown business plan for you, and that business plan can sit on your shelf, and if the IRS ever shows up, you have a business plan. If you don't want ours, just make one. Create a business plan and put it in a file and give it to your CPA, and this substantiates that you are in fact a profit-driven business. Maintain accurate books and records, including a P&L and a balance sheet, and add your offspring as an asset. So I'm not going to ask the question because I already know the answer. The vast majority of you are probably not keeping accurate books and records for your ranch. You might have some element of it, maybe at the end of the year, your CPA or your bookkeeper or your accountant throws it all together, but you really do want to maintain good books and records for your ranch. And there's a reason for that, because when the IRS shows up, if they show up, you want to be able to have robust books to be able to provide them to demonstrate that you have a real business. And this idea around, well, I have to make money and I have to create income, there's a bit of a fallacy around that. There's some element of truth that you do need to do that. You do need to be a profit-driven business, but if you're raising offspring and you take those offspring and you add them into your balance sheet, well, your business is in fact growing. The IRS cannot force you to sell your investment in order to generate tax. They can't make you do that. But if what you're doing is every time you have an offspring born, it's added into your balance sheet with a $1 value, the basis that you have in that animal is actually the feed cost, the cost of labor, all of the other costs that you're incurring. So because you didn't buy the animal, you're not able to put a value on it on your balance sheet. But if you just add it as a $1 item, you now have that animal on your balance sheet, and you're demonstrating that the asset base of your entity is in fact growing. And so again, if the IRS shows up and says, oh, well, you're not making any money, or oh, this is a hobby, and you generated $2 million of losses last year and the year before and the year before, yeah. Well, if you can demonstrate that you have $10 million of assets as it relates to WildLife, there's no argument about this. This is a very clear-cut business strategy as it relates to capturing these tax incentives. The IRS will eventually get their money when you sell those offspring. They will. They'll eventually get it, but they don't get to decide when you do that. Do not mix transactions with other entities. This is like the thing that I see happen more than you could ever imagine. So you have people that own ranches that are buying animals, and they're buying them through 5 different entities. One day they're writing a check out of their primary business, their construction business. One day they're writing a check out of the ranch entity. One day they're paying cash. One day they're writing it out of their personal bank account. One day they're writing it out of some other account. The money is not coming from the same place every time. That creates massive problems. It's massive problems from a liability standpoint, which we'll talk about with regards to insurance in just a few minutes. And I'll just give you a very short snippet. If you pay for an animal out of your personal checking account, and there is an accident that happens on your ranch with an animal, you have just subjected your entire net worth to the liability associated with that injury. But if you don't do that, and all of your purchases are structured within a very specific entity, the liability stops at that entity. If you're writing a check from your primary business, let's just say you're a lawyer and you have a law firm and you're writing checks out of your law firm to go and buy animals, you just subjected your law firm to liability. And most people don't think about this as they're operating these businesses, as they're engaging in this industry. And what I can tell you is these risks are going to come to roost one day. Someone is going to end up finding out that was a bad idea. Because when you have a lawyer on the other side representing someone that's been hurt, and they decide that they're going to come after you because you're worth $1 gazillion, they're going to do everything they can to get to all of your assets and not just be stuck within an entity that has limited assets. So the reason I'm going over this is that I would highly encourage you to talk to your legal counsel about the way in which that you're operating this business, because it does matter. From an IRS perspective, it helps you to avoid problems when you get audited, but from a liability perspective, it helps you avoid putting all of your personal assets or the assets of your primary business at risk. So the goal of talking about these is to get everyone to switch on, as Kevin always says. You know, I want you to start thinking about these things, because our industry doesn't need examples of people getting bombarded from lawsuits again and again and again and again. That we don't need that. And so it's important that we're all thinking about these things. So this is going to be difficult for me to read off this sheet, but I already know what it says, so that's okay. But for those of you that have this in your printout, it may be too small. If you can't read it, I can email it to you. This is the sum of what this is. This is actually the law. So this is the law around what we do and why it matters specifically. So, good morning, Ellie. So section 179 and 168K depreciation allows us to depreciate the animals that we breed. And why is that? It's because livestock at the federal level are considered to be business equipment. So I like a show of hands. I like participation. So has anybody in here ever, towards the end of the year, said to themselves, I need to go buy some equipment. I got to go buy some equipment, or I got to buy a truck, or I got to buy this, or I got to buy that in order to get tax savings. You've done that. I know Shane's done that. I'm sure lots of others have done it. I've done it, okay? Well, a kudu is the exact same as a caterpillar. It's the exact same as a truck. It's exactly the same as a printing press. It's exactly the same as commercial kitchen equipment. It's exactly the same. A kudu, a sable, a bongo, all of these animals are exactly the same. And I'll tell you why. Because our industry received some very favorable regulation quite some time ago. I believe the EWA is responsible for getting this done. It may have been a group of people. I don't know when it happened. But the ag code in our state, which is the very bottom paragraph on the right-hand side, it designates exotic wildlife as livestock. So at the state level, in the ag code, exotic wildlife is defined as livestock. And at the federal level, livestock is tax deductible as business equipment. Does everybody understand that? Does anybody have a question about that? No questions. Okay, I'm going to say it again just to make sure, okay? Exotic livestock, kudu, bongo, sable, Gemsbach, Arabian oryx, does not matter what the animal is, okay? They are designated as livestock in Texas, And the federal government says that livestock is tax deductible. It's depreciable under section 179 and 168, where you get bonus depreciation. Okay? Yes, sir.
So with that being said, can you keep an ag exemption for wildlife, or is that just for wildlife?
That's a great question. So the question that he's asking is about your ag exemption on your real estate. Okay, the ag exemption on your real estate is completely different than the exemption or the deductions that I'm talking about right now. I'm talking about specific deductions on the animal themselves. Your property tax exemption is what he's asking about, and the answer to that question is every county is different. There's currently regulation that's being proposed and being discussed at the state level to try to create some uniformity within all the counties in our state, because every county looks at this differently. So Kendall County does not look at it the same as Kerr County, and Kerr County doesn't look at it the same as Travis County. So the answer is every county is different. Some counties, they have a sheet that says if you have 5 Impala and 6, Ginsbach, that those constitute one LSU. Other counties don't recognize them. And so you're gonna have to go to each individual county, wherever your county is, and they will tell you whether or not they have specific designations for exotic livestock under the ag exemption for livestock. And a wildlife management plan doesn't include exotic wildlife. And one person you can certainly ask about this, where is Warren? Warren, did he walk out? Okay, Warren over here is a guy that can help with that, and so he can answer some of those questions, but it really depends on your county, okay? Okay, so this is actually getting into my really most favorite subject. So we're gonna utilize section 179 and bonus depreciation. And on the left-hand side, I'm gonna talk about what was going on before the passage of the big, beautiful bill. And I have been thinking about this bill that just got passed since 2017, when the 2017 Tax Cut and Jobs Act got passed, because as you can see in these percentages, there's a phase down. So what that means is that from 2017 until 2022, if you went out and bought exotic wildlife, you got to write it off 100%. 100% in the year you buy it. And then in 2023, they changed it to 80%, 2024, 60%, and then 2025, it was 40%. So I don't know if any of you noticed, but between 2017 and 2022, does anybody know what happened in our industry? What happened, Nash? Prices went bananas. Like, they went crazy. Like, people were getting worried because prices were going up so fast. People hated me. They blamed me and said it was my fault prices were going up, that I was artificially inflating the industry. And so I'm telling you why it happened. It happened as the result of education, and it happened as the result of this law. This law facilitated business owners being able to buy animals and get a 100% tax write-off in the year that they buy them. And then, since we've started to see the phase down, has anybody noticed what's happened with pricing? We've started to see a decline in pricing. There's been less demand, right? There's been less demand in the wildlife industry. There's been more volume of available animals, and as the result of that, you've seen some prices come down. It is directly tied to this. We didn't magically just suddenly one day wake up and have lots more animals. I mean, the only way we get more animals is by breeding. And there's more people in the industry today than there was in 2018. And so this tax element of this drives our industry, just like it drives every other industry in America, which is why this bill was passed. So I'm gonna give you an example here. If you bought $1 million of business equipment in 2025, before the big, beautiful bill passed, you were gonna come out of pocket $1 million. You're gonna get a $520,000 tax deduction. The reason for that is you get 40%, and then bonus depreciation. You're getting 40% through bonus depreciation, and then you get 12% over a period of 5 years. So you're gonna get the 60% that's there, you get You break that over 5 years, so you're getting 12% per year. So in the first year, you're gonna get to write off 52%, which is 520 grand. So you're gonna save 195 grand in tax if you're in the 37.5% bracket. But you still have taxable income of $480,000 that you owe tax on. So you spent $1 million, you bought business equipment, you got a $520,000 tax write-off, you saved 195 grand on your tax bill, but you still owe tax on 480 grand, and at 37.5%, that's 180 grand. So where are you gonna get the 180 grand? You spent your $1 million. Like, you bought the animals. So you're in a situation where you spent your $1 million, but you still owe 180 grand in tax. And this is why the decline in depreciation is so detrimental to industry all over the United States, is because what ends up happening is if business owners go out and they buy equipment with cash, not with finance, but with cash, they end up with a tax bill even though they already spent the money. And the result of that is people stop buying business equipment. That's what happens. People stop buying. They don't buy more airplanes, they don't buy more helicopters, they don't buy more tractors and trailers. They just say, well, I'm gonna wait. And when interest rates are where they are today, that makes them wait even more. And so the result of this is that eventually, when you have these kinds of things going on, high interest rates, and you have depreciation doing this collapse, if you will, it is a recipe for disaster in our economy. It is guaranteed to collapse the economy. And so what ended up happening is we got the benefit of this bill that just passed. Just out of curiosity, I'm sure everyone in here has heard of the Big Beautiful Bill. Do you guys feel that you understand the significance of why this is important, not just for our industry in the wildlife business, but for your businesses, for what you do? And this is what I don't think CPAs talk to you about. This is what I don't think you hear on a daily basis. You hear, oh, it's going to be the greatest tax increase in American history if this bill doesn't pass. And you hear the Democrats saying, oh, well, they're just giving it to their rich buddies and blah, 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 blah. But at the end of the day, what does it actually mean? Well, what it means is if they didn't pass it, we were going to end up in a situation where depreciation was going to go back to 20% while simultaneously dealing with high interest rates. And when when they're not investing in their businesses, they're not growing. And when they're not growing, they eventually end up having to lay people off. They eventually end up not being able to employ people. And as the result of not employing people, we go through a recession. But fortunately, as the result of this election that passed, we have Trump in office, and we are in control of the House and the Senate, and there's regulation that has been passed that's incredibly favorable to all Americans. It's not just us, it's the whole country. It's a huge deal. So I'll walk through this example again, okay? So this is now that the bill passed, and what this bill did is that it took depreciation back to 100% permanently. Not for 4 years or 5 years, permanently. So from here on out, unless the Democrats go and change this by getting 60 votes in the Senate, this is the way it's going to be moving forward. And so with that said, and for what it's worth, this is retroactive to January of 2019, or January 19th of this year. So anything you bought from January 19th forward qualifies for this treatment. Even though the bill hadn't passed, they made it retroactive, okay? So taxable income, if you made $1 million and you owe the IRS money, and you say, you know what, I'm not gonna give them the money, I'm gonna buy $1 million of kudu, or tractors, or whatever the case may be, you're gonna spend $1 million, you're gonna get a tax deduction of $1 million, you're gonna save $375,000 in tax that you owed the IRS, and you have no taxable income remaining, but you're still sitting on your $1 million asset that you bought. You do not have a tax bill due, but you're still sitting on an asset that's worth $1 million. So you took your $1 million, you put it into an asset that the IRS allows you to write off 100%. You no longer owe any tax, but you still own the asset. I don't know if anybody likes that idea, but I like that idea. Like, I like it. I like the idea of not having to give the IRS my money. I like the idea that they are willing to subsidize my kudu purchase at 37.5%. So the 375 grand, if you make $1 million, that's not your money anymore. That's their money. You're just still holding on to it, but you have to give it to them. You're giving it to them in quarterly estimates, or you're paying it at the end of the year, but it's not your money. But they say, I tell you what we'll do. If you'll take the 375 that you owe us, and you'll partner that up with 625 grand of your own money, we will let you go out and buy bongo. But we don't, as the IRS, own any of your bongo. You own all of it. You own 100% of the bongo. But the IRS is going to subsidize that to 37.5%. And I don't know if any of you have had a CPA tell you this in the last couple of months, or I don't know if any of your accountants have said, hey, the big beautiful bill passed and the IRS is going to subsidize your purchase. But that's exactly what they're doing. And so I'll give you another example here. Let's just say that instead of using cash, you decide you're going to use a line of credit. Let's say you've got a line of credit set up for your operating, for your business, or whatever the case may be, and you're going to use your line of credit. So you made $1 million, you owe tax on the $1 million, you use your line of credit to go out and buy business equipment, so you did not spend any cash. You're still holding your $1 million because you used your line of credit. You're still going to get your 37.5% tax savings. The IRS doesn't care if you borrowed the money or whether you paid cash. It doesn't matter to them. So you're going to get your deduction, and so you now owe $0 in tax. But what do you have? You have $1 million in cash that you earned that previously you would have owed tax on, and you have $1 million worth of animals, or whatever the business equipment that you bought is. And so you're sitting on $2 million worth of assets, and you have a loan that you have to make an interest-only payment on, right? But when you're still sitting on the $1 million, are you all that worried about being able to make the interest-only payment? And the answer is no. It provides people a tremendous amount of security when they get this benefit of being able to write this off 100%. And so the result of this is that people start to not care that interest rates are 7% or 8%, whatever the case may be. I don't know about you all, but personally for me, I can go out and borrow money at 8%, and I can make far more than 8% breeding exotic wildlife. Way more. I can generate a way better return on investment than 8% annually breeding exotic wildlife. It's not difficult for me to do, and hopefully it's not difficult for you to do. And so as long as you're covering that 8%, you're able to do this with money that's not even yours. And so there's another fact to this, is that you can insure all the animals. So for some reason, let's just say something goes wrong, and you have insurance on the animals, and so it secures your line of credit, which is going to make the bank very happy. So with all that being said, the passage of the big beautiful bill has created an environment where with 100% deductions, businesses are going to start buying equipment, even though interest rates are high. You're going to see it in ag equipment, you're going to see it in vehicle purchases, you're going to see it in manufacturing equipment, you're going to see it in the wildlife business. It doesn't matter what industry you're looking at, you are going to see businesses beginning to reinvest in their companies, and you'll find that they're using leverage to do it in some cases, and in other cases they're not. But the result of that is this is creating a tremendous buying opportunity in all sorts of industries, but it is certainly creating one in our industry. Okay, so I'm going to talk about the impact on real estate, and I'm going to try to keep moving through this because I don't want to miss anything. So one of the things about when you have a breeding business on your ranch versus a vacation property is that all these other things that you're doing become tax deductible. So when your ranch is a hunting property for you and your friends, and you have an employee that works out there feeding, that's not tax deductible because you don't have a business. The feed that you're buying, it's not tax deductible because you don't have a business. When you improve the roads, it's not tax deductible. If you drill a water well, it's not tax deductible. Nothing you do on that ranch is tax deductible because what you have is a hobby. It's just a hunting range. It's just you going out and having fun with your family, and you can try to play this little game of I send a guy out there from my company to go hunt, and therefore I have this business. It may sound great, but it doesn't really work all that well. But if you have an exotic wildlife breeding business, all of your roads, ponds, fencing, barn, irrigation, water wells, feeders, gates, trees, shrubs, grass, crops, windbreaks, I can go on and on and on and on. Some of this is eligible for cost segregation. Just show of hands real quick. People know what cost segregation is? You do, a couple of you do. Cost segregation is this: you cannot write off a building, okay? So if you buy a building, you can't write it off. But you can write off nails, and you can write off sheetrock, and you can write off 2x4s, and you can write off shingles. And so cost segregation, there are companies that will do this for you if you don't know how to do it yourself. But cost segregation allows you to write off things that would otherwise not be deductible because they don't fit under the tax code. So I'll say it again: you can write off nails, you can write off 2x4s, you can write off sheetrock, you can write off shingles, but you cannot write off a building. And cost segregation is the way that you go about doing that. So when it comes to building a barn dominium for the people that are coming out to buy your animals, you have to put them up for a night, don't you? I think you probably do. They need to stay the night, get a steak, and talk around the campfire and learn a little bit about the animals. And so that barn dominium that you built, you can't write the barn dominium off, but you can write off parts of it through cost segregation. And again, these are things your CPA is not telling you. So these improvements do magical things to your real estate. When you're putting in a pond, and you're putting in water wells, and you're putting in fencing, and you're putting in a nice entry at the front, and you're putting in trees and shrubs for windbreaks to protect your crops, all of those trees and shrubs, all that's deductible. So suddenly, the IRS is subsidizing the improvements that you're making to your real estate. So here you have this property that you cannot go and write off the improvements that you would make when it's a vacation property or it's just you and your buddies hunting. But when you have a breeding business with good books and records that's structured as an entity, and you have a business plan, and you're making sure to keep an accurate balance sheet and an accurate P&L, and you're monitoring all of these investments that you're making into your real estate, suddenly this land that you bought for $5 million, it's worth $7 million because of the improvements that you made, and the IRS subsidized 37.5% of it because they're letting you write it off. And so, again, it goes back to simply switching your brain on and turning this from, okay, this is more than just me having fun, this is more than me just liking cool animals, this is more than me just showing off to my friends. This is a really significant tool that will enable you to stop giving your money to the IRS, because they've given you the ability to not, you don't have to do that. It's not required. You don't have to do it. There are tools that you can use to do things to your benefit and your family's benefit if you will simply use these strategies. Qualified business income, I'm not going to go in great detail about this, but the long and the short of it is, if you have a pass-through entity, an LLC, a limited partnership, a general partnership, an S corporation, a pass-through entity essentially means that the taxable income of that entity flows through to your personal tax return. Under the 2017 Tax Cut and Jobs Act, they created a provision that allowed the first 20% of your income to be tax-free. They re-upped that with the big beautiful bill. So if you have a business and you make $1 million in your business and it's a pass-through entity, $200,000 is automatically tax-free. Automatically. That's not W-2, that's a business. So if you have a pass-through entity, the first 20% is tax-free. There are some provisions around the W-2 wages that you're paying out within your company that create some limitations. I would encourage you to get with your tax counsel on that to make sure that you're getting the maximum benefit. But this is not there just for the benefit of business owners. They want you to employ people. So the more W-2 income that you have that you're paying out, the greater the benefit that you get from a tax perspective. Short-term versus long-term capital gains. So when we have an offspring baby, okay, this is an asset. So when we sell that asset, it's a capital gain, and there's a designation between a long-term or a short-term. If you hold it for less than 12 months, it's short-term, and if you hold it more than 12 months, it's long-term. So why does that matter? It matters because if you have an animal and you sell it when it's 6 months old, your tax rate that you're paying on your active income is what you're going to be taxed at. And for most of you, I'm sure it's the top tax bracket, which is 37.5%. So that means if you sold the little baby animal for 10 grand, the IRS is going to take $3,750 of your money. But if you just hold it a little bit longer, if you just hold it until it's 12 months and 1 day and you sell it, they're only going to take 15%. It could be up to 20% depending upon how many capital gains you have, but it's a difference of 15% versus 37.5%. So if you just wait a little time, there's a 22.5% difference in tax when you sell the animal. So think about these things when you're doing your record keeping. When you're entering your offspring, you need to think about the date that you're entering them and the birth date that's associated with that animal, because if and when you get audited, the birth date of that animal is going to dictate whether it's long-term or short-term capital gains when you sold it. And one thing I'll add to this is a very unique thing for our industry. If you look at other industries, and I'll just use construction as an example, right? So in construction, I'm going to go out and I'm going to buy a bulldozer. Let's just say as an example. And when I buy the bulldozer, I get to write off however much the cost of the bulldozer is. In the wildlife business, I go out and I buy bongo, and I get to write off whatever the cost of the bongo is. So the treatment is exactly the same. The bulldozer is going to just sit there unless I hire someone to get on it and drive it. And it's then going to have to go out and it's going to have to do the work because someone's hired me to come do work, right? And so I have to go through this process of getting my bulldozer to go to work. Well, then all of the income that I generate from using that bulldozer, it's active income. It's taxed at the very top tax rate, 37.5% if you're in the top tax bracket. If you're in another state, it's even higher than that with state income taxes. And so all of the revenue I'm generating, it's whatever my tax bracket is. But my bongo, I have to feed it, and I gotta have a place to put it. And I might even need somebody to look after it. But that bongo does this magical thing, and it just has a baby. And that baby, if I hold it for 12 months, I'm only taxed at 15% versus 37.5%. This is a very unique thing for our industry, and it gives us a significant advantage from an overall profitability standpoint when we're getting a 100% deduction, but from an income standpoint, we're getting tax-favored income. It's a tremendous benefit for what it is that we do. Selling hunts, this is really important, and I think most people overlook this. So when you buy animals with the intention that I'm gonna hunt this animal, so let's just say you go out and you're buying a bunch of young males. They are non-deductible. You cannot deduct them. Those animals are considered to be inventory. It's no different than a restaurant going out, buying tomatoes, putting it in the refrigerator because they're going to make cheeseburgers. It's inventory. It's non-deductible. You do not get to deduct it. Once you hunt the animal, okay, let's just say you have the animal, you hold it 3 years, you then go out and it's hunted. You owe tax at ordinary income rates on the difference between what you paid for it and what you sold it for. And I'll give the example of that in just 1 second. So you're going to pay 37.5% income tax on the money that you made on that animal. That's how that works. It's a huge disadvantage. And I'm a hunter, I love to hunt, but I'm a financial guy and I love money and I like tax strategy, and when you compare these two side to side, they're not the same. They're treated very differently from a tax perspective. So it goes back to when you're buying animals, keeping good books and records. If you're buying animals and you're thinking, oh, well, I'm buying these, they're grow outs, and what I'm gonna do is we're gonna shoot them eventually. Well, you need to think about the way you structure that because you're treated differently from a tax perspective. So I'll give you this example. If you buy $1 million of males to grow out for 3 years, you get 0 tax deduction, which means, okay, you owe tax on the $1 million even though you spent it. So you still owe 375 grand in tax because you get no tax write-off. So You then sell those animals 3 years later for 1.75 million. So hooray, awesome, I did great. I made a bunch of money, right? Well, you gave the IRS 375 grand to the $1 million. Okay, you owed tax. Now you have to pay tax again on the 750 grand, and they're gonna take 37.5% of that. So how great is this? Like, I don't think it's that great. I don't think from a financial perspective it's all that great. You made 75% on your money in 3 years, but the IRS is taking the majority of it. They're taking a huge percentage of the money that you created. So if you sell the animals for a hunting fee, in other words, I'm not actually selling the animal, I'm selling a fee, it's a service fee, right? Then what you do is you get to write off the $1 million, but you have to pay tax on the 1.75 million when you sell the animal. So it's all recaptured. You lose all of the tax incentive. So what I would encourage you to do, and I'm not gonna just keep going on this, but what I would encourage you to do is sit down with your CPA and really create a plan as to how it is that you're doing this, because it matters. It matters at the end of the day, unless you want to just keep writing checks for quarterly payments to the IRS. So I'm not a fan of quarterly payments. I'm not a fan of annual payments. I don't like giving the IRS money. And so, again, I will reiterate, and there's a few more things to go over in this presentation, but before I do that quickly, I want to, does anybody have any questions about anything that I've gone over thus far? Yes, sir. Yes, sir.
You're not selling a hunt, you're
So
selling
think about it like this. When someone is hunting, right, are they buying the animal or are they paying a fee to shoot it? At the end of the day, the outcome is the same. The only different, go ahead.
Go ahead, yeah, no, I understand that part, so basically on the books, so when I reported on the books, I'm reporting a fee. So,
If you're recording it as a fee, okay, then you would have been able to write off the animal in the beginning, but you're subject to recapture. Okay, so you're going to have to give all the your tax, paying tax on the full amount is essentially the way that works. Yes, sir.
So what's your best answer when your CPA says you can only write off your passive income?
So there's very clear designations within the tax code related to this activity, and if your CPA believes that you're passively involved, then you're not going to your ranch enough. So there's a set of requirements. The minimum requirement is 100 hours a year, but if you meet 500 hours a year, there's no question that you're actively involved. And that 500 hours is accounted for in some really creative ways. So for every minute that you spend sitting here, that goes towards your hours. Every minute that you spend researching things on the internet, that goes towards your hours. If you're going to online auctions and you're bidding or you're looking at online auctions, all of that goes towards your hours. So what I would say, if your CPA is telling you it's passive, you're not doing a very good job of being actively involved, or he just doesn't understand how involved you are. So if you follow up with me, I'll email you the set of provisions that dictate whether you're materially involved, whether you're active. It's very easy to accomplish, particularly if you're a landowner. So if he's, look, I'm going to say this because I feel like I'm in a position to do so. CPAs don't care about whether you're paying tax or not. It's not their money. They are always going to err on the side of caution. At least that's been my experience. I have been fortunate enough to find some great tax teachers that have really helped me to understand the code. Most CPAs, in my experience, are what are referred to as tax filers. They're not tax strategists. They enter things into software and it spits out a result and they tell you to write a check. That's kind of the way that works. And so if you own a ranch in this state and you have animals on that ranch and you're out at that ranch periodically, you should have no issue whatsoever getting active participation as it relates to tax treatment. I cannot think of a reason why a CPA would classify you as passive other than you don't have a lot of passive income and he doesn't want you taking the write-offs. So, and I hate sounding negative. I don't mean to talk that way, but I've talked to hundreds of CPAs that are giving their clients terrible advice, and when I show them these things in the code, they don't argue about it, and they change their position, and in some cases they amend returns from prior years. So this is not a loophole. This is very, very easy stuff to understand. So feel free to follow up, and I'll be happy to email you those provisions from the code. And you may be a CPA for all I know and setting me up, and that's okay. I'm willing to dance.
Definitely not.
Any other questions? So you guys are all tax professionals now. Awesome. So really and truly, the purpose of this is to encourage you to ask questions and to get as much knowledge as you can. So if you don't have questions, great, I'll move forward. I'm going to ask one more time. Yes, sir.
The last one you looked at on that monthly, something that month,
Okay.
how would that, which way should that be?
Okay, so if all you have is males, you do not have a defense to say that you're in the breeding business. Okay, but if you have females, you have a defense to say that you're actually breeding the animals. But if you go out and in your books you say, I'm buying these animals with the intention of growing them out and hunting them later, you've now just put yourself in a position where those animals are classified as inventory. So inventory is non-deductible. So whether you're a bookstore or whether you're any other kind of business, inventory is not deductible until you sell it. And when you sell it, you pay active income on the difference between what you paid for it versus what you sold it for. So I can't tell you exactly how to structure your particular situation, but what I would say is that I would avoid having inventory. I would not want inventory related to the animals that I have living on my ranch, because you're going to pay active income tax when you sell them versus capital gains. So the way to solve that is to have females of every species that you own. If you ultimately end up shooting an animal, it's a dead animal. It's dead. It's dead just like if it fell over and died. It's dead if it ran into a fence. It's dead if lightning struck it. The IRS doesn't ask how it died. It's just dead. And so if it dies and you get paid for it, you're subject to recapture on what it is that you wrote off, and then you pay the difference in tax on whatever's left over as a capital gain. So if you want to follow up with me, I can give you some more in-depth answer, but every situation is a little bit different. It's why having great counsel is good, but your question is exactly why we're here today. I'm trying to get you to turn your head on and say, how am I doing this? And then go through the process of creating a plan that gives you the maximum positive benefit from a financial standpoint, both from a cash flow standpoint and from a tax benefit standpoint. So your problem can be solved. I just don't know we can solve it today. Yes, sir.
Well, if you turn exotic, and you assume all this still applies if it's white tail or indigenous species?
No, sir. So exotic livestock is defined in the Ag Code. It's on your sheet there. There's some gray areas like around a kangaroo. There are some species that may or may not qualify for that treatment because they're not cloven-hoofed animals. White-tailed deer in this state, you cannot own them. It's not yours, you don't own it. You have a right to breed it, you have a right to sell it, you have a right to shoot it, but you don't own it. So it's not an asset that you technically own. And so there historically has been a method for how people have accounted for these things. It may or may not pass muster with the IRS because you don't own it. It's not an asset that you own. You're just simply getting a licensing fee is basically what you're getting. So elk, red deer, those are all considered to be exotic. They're not native in this state, so even though they are here, they're considered to be exotic. So they're not the same as a whitetail. Okay, yes. So federal law is purely talking about livestock. So I can't get into the details related to another state's perception of how they view elk or red deer or things like that. But in our state, all of these animals are classified as livestock. I would say that you probably would, if elk is native in the state you're in, I don't know what the laws are related to ownership. You know, lots of states have different rules for whitetail. Some states you own and some states you don't. It really comes down to whether you own the animal. think I saw another hand go up somewhere. Yes, sir.
Is there a minimum or maximum that you have to spend or need to spend for the tax benefits?
The answer to that question for me is whatever it takes to zero out the tax bill. That's the answer. So there is no minimum or maximum. So if you're someone with W-2 income, this still works for you. If you have K-1s through investments and partnerships, it works for you. There is no minimum or maximum, and you have the ability to eliminate your tax bill. There's not a restriction, like on charitable contributions, you're limited to, I think it's 30%. With conservation easements, it's 50%. If you're a farmer, it's 100%, but there's no limit in terms of how much you can erase your tax bill related to this type of an operation. Any other question? Okay, I'm going to run through the next part of this very quickly, okay? This is online from previous events, so you can go watch it there. What we're doing is not something that's new. South Africa already did this. They privatized ownership of game in 1991. As the result, there was billions of dollars invested into the marketplace, and what that resulted in is they went from roughly 100,000 animals in private hands to 28 million, roughly. It could be 25 million, could be 20 million, nobody knows exactly, but the long and the short is it's the greatest conservation success story that's ever existed in the history of this world. South Africa privatized ownership of game, and the result is people could make money on it, and they went through this enormous boom from 1991 until 2018. 2018, the market collapsed. It went through a significant downfall because of saturation, and then now the market is recovering and it's doing really, really well. It's gotten back on its feet and it's doing really great. So COVID played a role in that, but the long and the short of it is we're duplicating what's already happened in South Africa. This is the building of our dynasty in the wildlife industry. So this started in the 1920s or 30s when the King Ranch imported nilgai. You can walk through this whole chart and it'll show you the growth model. Where all of this data comes from is public publications that are available online. And what you've seen is because of zoos in this country shipping us animals, these animals are not being imported by private Billy Bob Oil Man bringing animals in from Africa. That's not what's happening. Zoos in America breed animals, and the result of them breeding animals is they ship them to us because they run out of room. And so that's where all these animals came from. So we have gone from just a couple of animals in the 20s or 30s to, in 2018, roughly 100,000 super exotics. That's just a wild ass guess because nobody's done any great surveys in a long time. I think that number today is probably closer to 200,000, but it's just a wild ass guess. Unfortunately, that is being updated right now. A&M is doing an updated economic impact study. But until we as an industry start taking the steps to get real meaningful data around population, we're just guessing. But we know it's not a bazillion animals because we just didn't start with that many and we can't import them. It's just through breeding that we're increasing. This is talking about investment performance, and this is going to show you what we've seen in the market going back from 2012 through 2024. The species that you see here have primarily done very well, and they've kind of done well even through a little bit of a downturn. But this gives you some indication as to what kind of returns that we've seen just from an investment on buying animals, not even including the breeding. Okay, I will run through this quickly. So this is an example of if you bought black wildebeest, and let's just say you bought 1 male and 5 females, you're going to spend 10 grand on your male, and you're going to spend 50 grand on your females. That's about the market rate today. So you're going to spend $260,000 to buy these animals. That's 10 plus 250. So you're going to get to write all that off in the first year. So your tax savings is $97,500. That's what the IRS is subsidizing for you. So your net investment is $162,500. That's what your investment is. Because you already owed the IRS money, they just let you take that 97 grand and put it into black wildebeest rather than giving it to them, right? So your net investment is $162,500. How much is the asset that you own worth? Anybody?
260.
That's right, it's worth 260 grand, right? The asset you own is worth 260, but your net investment is 162,500 bucks. So let's just say that your black wildebeest, that they're friendly with one another, and that the male bought some flowers and played some music and everything went really well, and you ended up with 4 babies. You didn't get 5, you only got 4, right? So one of them just decided she didn't like that guy. So the result is, on your males, when you sell them, you're selling them at wholesale, because you have to get somebody to come catch them. Unless you're really good at getting in a helicopter and shooting a dart gun and all those things, you have to get someone else to do it. So they're gonna pay you 5 grand for your male offspring, and they're gonna pay you 35 grand for your female offspring. So that means that you've generated 10,000 on your males and 70,000 on your females, which is $80,000. Is there anybody out there that has any investments this year where you've got $162,000 in it and it's cash flowing gross 80 grand? That's 50% annual cash flow. Now that's a gross number. You have to have real estate, and you gotta feed them, and you gotta have somebody out there to look after them and that sort of stuff. But this is a gross number that you're gonna have some overhead, but it's not enormous. So if you get 80% production, and you have 4 babies, and it's 50-50 split male-female, you're looking at, let's just say it's 30 to 40% annual cash flow if you can keep them alive. But the great news is that nowadays you can buy insurance for them, so even if something goes wrong, your investment is protected. I'm gonna just talk about one of these, and you guys can look at the rest of them. What I'm showing you here is what was imported into the United States based on AZA records. The Association of Zoos and Aquariums is nationwide zoo. That's who is accrediting the zoos in the cities we all live in, okay? They have records dating back to the early 1900s of imports that have come into this country. And so the founders, that is the imports, okay? So we're dealing with very limited genetic base. It's very limited. Like, when people say, oh, well, my genetics are better than yours, well, they all came from pretty much the same spot. It just so happens that through breeding, some of these great qualities are showing up, like this 71-inch kudu. Like, this is pure luck. This didn't happen because we just found the best of the best of the best genetics. This happened out of luck. And so somehow there was 70-inch genetics in kudu, in the 44 kudu that entered this country, miraculously. And so if you look through these records on all of these individual species, it gives you an idea of what the populations are. These are very, very limited populations. You're not talking about tens or hundreds of thousands of animals for each of these species. It's a very, very small number of animals that lots of people are fighting over. The last thing is springbok as an example, monthly female sales. It is less than 20 females sold every month. So when you're buying springbok for your ranch, you can be sure there's not 100 springbok available that month, or the month before, or the month before that. It's a very small number that's moving each month. And so this is what ultimately drives prices. When people figure out that they can write these off 100%, that they can improve their real estate with tax-favored money, and it's tax-favored income, suddenly you start developing this buying frenzy of people fighting over animals, which is going into supply and demand. So the long and the short of it is, we have seen a drop in price over the last few years. We just had a bill get passed that completely alters the face of our industry and all industry. And if you don't see that as an opportunity to take advantage of the fact that right now prices are down on some species, you are missing the boat. Between now and the end of the year, I can tell you our company will see, if I just have to guess, we will probably see somewhere in the range of $40 million of capital flow in for the purchase of WildLife. Other people are going to see the exact same things happening to their businesses, where people are wanting to buy animals to get these tax write-offs by the end of the year. And next year, if the economy does what everybody thinks it does, with interest rates coming down, you're gonna have the same tax problem next year, which means that you buy more animals next year. And if the economy keeps going in that direction, you have the same problem the year after that. And so favorable tax regulation coupled with a great outcome on an election has put us in a position where we have the ability to really capitalize on investing in our ranches, investing in our animals, and making a great return on investment while not having to give the IRS the money. And I'm not going to go over that slide. And there we go. So I'm going to wrap up my presentation. Does anybody have any questions before I close and bring up the next person?